Welcome to Dissect and Detect. Here at Phoenix Blue, it's the 13th of March, Sunday morning, looking over the River Thames to a lovely, lovely, cold, fresh morning. How was everyone's week last week? Well, I do know that anyone that is trading underneath the Phoenix Blue methods will have been having not only a good week, but a very, very good year. This, may I say, I really do hope continues, but we do have to be prepared because at some point we are going to have a period of trading that is not going to go the way we like. Now, the one thing that we will always say is with our risk management and our calculated stops and take profits, we will or should never ever have a really bad trading week or bad trading month. Okay, we can have a month or a week that we don't like, but the way we use our risk management should always mean that if we do have a bad week, it shouldn't be bad enough that we can't regain what we lost the following week or the following month. So we do have a very strict policy with risk management. Now, last week was a very, very interesting week. We saw some huge announcements, some very, very good announcements. And what I mean by good announcements, when we talk about the RBNZ, they cut interest rates. Okay? So that shows that they're trying to weaken their particular market. When we have news like that, that gives us clear direction that they want to see a weaker Kiwi dollar. So therefore, at Phoenix Blue, that gives us a bias. It gives us a bias that we should primarily be looking for shorting or selling Kiwi dollar. The other bit of major news last week was Mario Draghi came out, increased stimulus massively by a further 20 billion euros a month, cut rates even further, but he did announce at the tail end of this, after we saw an incredible sell-off in the euro, he did announce that this was probably all that they would be able to do at the ECB, which then basically created a huge rally after a drop of 150 pips in the euro to see a rally of 300 pips. So where is the euro going to go from this? Well, the question is, what are the Fed likely to do this week? So everything's in the balance now. We're looking for more clear direction. Well, the RBNZ gave us clear direction. Mr. Draghi, in a way, has given us direction for the euro, saying about their package that they're about to do with stimulus. We should see a sell-off in that, really. Now, the question is, what are the Fed likely to do? What are the Bank of England likely to do? Well, we've got these news announcements coming up this week. So let's just take a look at the news announcements we've got this week. It is pretty hefty. And I didn't put all of the news announcements down because there was quite a lot to put in. So I just selected the ones that I thought would be primarily of use to all our traders at Phoenix Blue. So we've got the RBA meeting minutes. Okay, this is where we want to have a look within the meeting minutes. How are the RBA looking at their economy? Do they see further upside? Are they happy with the price of the Australian dollar? Are they prepared to put any more stimulus? Are they prepared to cut interest rates? What are they prepared to do, and where do they see the Australian economy? How much is China weighing on the RBA? How much are commodity prices? So these are things that you're going to have to look and we learn to compare from speech to speech. Then we've got the Bank of Japan monetary policy statement. Well, as we are fully aware, earlier on, a few weeks ago, the Bank of Japan brought in negative interest rates to see a desired effect that they were looking for, which was a sell-off in yen, only for it to then just drop from roughly 120, 170 right the way down to 110s. So we saw 1100 pip drop or strengthening of the yen, exactly the opposite effect to what the Bank of Japan were looking for. Then obviously we've got another statement or meeting from the ECB. This is non-monetary policy, so maybe they can counteract Draghi's last statements in there and maybe create a sell-off, who knows, but we're not going to try and second guess what they're going to talk about in these meetings. We're just going to analyze what they do say afterwards and then create an argument based on fundamentals, then look for our technicals, and then trade based on both lining up. And then we've got the SNB press conference. Well, we do know from further announcements that the SNB do feel that the Swiss franc is overvalued. So at some point in the future, whether it's going to be near future or later on midterm future, we don't know, but I can see further easing of the Swiss franc. Then we've got the FOMC economic projections, interest rate decisions. The consensus is it's going to stay the same. Will they talk about a rate hike in June? Who knows? Will they talk about a rate hike later this year? Again, this is something that we really need to pay interest to and see how they talk about their interest rates, how they talk about emerging markets. What is that having an impact on the Fed? Because all of these decisions all of these external influences are having an impact on whether the Fed actually increase rates or not. The actual state of the economy in the US is good. The labor market is good. GDP is good. Manufacturing is still over 50 and still expanding. So all the ISM numbers, that is. So the state of the US economy is actually pretty good. Hourly earnings are going up. Now, after that, we've then got on Thursday the rate decision coming from the SNB. We've got an interest rate decision coming from the Bank of England. So the last time on the vote cut or the vote hike for the UK was the first time that it was 9-0. Previously to that, we had one member that was always for the argument that we should increase interest rates. This hasn't been done, and it's flipped to 9-0. So the consensus here that the rates will stay the same, but what will they talk about in terms of future policy? Are they going to look at increasing rates? Is it going to stay neutral? Even if it stays neutral, is that a good thing or a bad thing? Well, what it does, it shows us that they aren't prepared to weaken the currency any further. They're not prepared to strengthen it. So what we can do is we can then look at trading, say, sterling with another market that is easing. So we could look at maybe pound New Zealand. You buy in the pound if they're neutral, and we're selling the Kiwi dollar if the Bank of New Zealand are looking at cutting further. So we've also got nice technical levels on the pound New Zealand in and around the 2.1 number. So that's the kind of thing we do here at Phoenix Blue. We trade strength with weakness or neutrality with weakness. We always want to see a divergence between one economy to the other. So that's enough on the news now. Let's make a note of charts and where we can potentially look at trading. So here's the dollar index. What we can see is the yellow box marking off numbers between 97.50 and 95.50. That's in between this yellow line down here and this yellow line here. So this is our neutral zone for the dollar. Whatever the dollar index is in here, we are neutral, i.e. we'll look to be buying and selling potential markets based off levels on majors and minors when we see the dollar index in at 97.50 or in at 95.50. If we get a break and close below 95.50, which is the bottom line down here, then we're bearish the dollar. If we get a break and close above 97.50, we'll be bullish the dollar. Now, if we take this across and we actually have a look at our commitment of traders. So this is something that we do actively teach here at Phoenix Blue. This is the Commitment of Traders report. This is the closest thing that we have to a centralized exchange when it comes to the currency and commodity market, because with FX you will know that there isn't one exchange. So because there isn't one exchange, when people talk about volume, the only volume that they will see is whatever's disclosed from their brokers, or maybe on some kind of site where you get an amalgamation of multiple brokers. So we use the Commitment of Traders because this is, we can see all the futures and options contracts and who is buying, who's adding to their long contracts, who is adding to their short contracts. And then we can see who is driving the market, whether it's commercial traders or non-commercial traders. So what we're looking at here is we can see that the dollar index is at an extreme. This is an index made up from 0 to 100. And then down here we're looking at our long contracts. So what you'll notice is the long contracts, I've put in this yellow horizontal line. And where this yellow horizontal line is, I've then put arrows up, and we can see that when the long contracts get in and around this sort of 17,000 barrier of long contracts, we start to see a bullish move in the dollar index. Now, what we look at is also support and resistance levels. So we can see that the market is pulled down each time into this yellow trend line and this red horizontal that I've pulled in. So what we're looking for maybe is this pull down back to 95 to 95.50 on the dollar index. If that is going to happen, what we'll see is the commercials should increase their long contracts and we'll get a pop through this yellow line, at which point this will coincide with our analysis on the euro and the Swissy that you're going to see shortly, and we'll expect to see the dollar index have its next push up probably to 97.50. Okay, so here we are. This is the euro dollar. Now the blue box, as you can see on here, this is highlighting the trap range that is marked off on the dollar index. I've got two options here. You can see the red directional arrow and the green directional arrow. I'm not prepared to buy or sell this market right now, but what I will do is I will use this market and cross-reference it with the dollar index, and I'll look to trade the range from 109.50s or to 1.14s, which you can see highlighted with the fib levels and with clear structure. Okay, you can see the fib levels drawn from highs to lows, or I should say from low here up to the high, and we can see where these fib levels come through, and what I'm looking for is where I can see an interaction with price and the fib levels. Okay, the next chart we've got here is dollar yen. Okay, now the dollar yen, we can see we've got a couple, this trend line here goes back a long way. This is off the weekly chart, and then we can see here we've got nice little, we can see from here break, retest, retest, retest. So we've got four very clear touches of this trend line here and two back here. Now we do have a resting order in at 111.15 with first targets up at 112 and then ultimate targets of 114. We do have a bias that it is going to break to the upside, pull back down, and we're going to look to get back in. Now there's multiple reasons why we're looking to get long this market. We're looking to get long because obviously what happened here with the Bank of Japan bringing in negative interest rates, only to see the market sink and strengthen. Now on the back of that, why is it strengthened? Well, it's strengthened through market uncertainty, and Japanese yen is a safe haven. Now you notice I've got no fib numbers or anything on this particular chart. It is just a blank chart. So markets that we're looking at, we've got a couple of options. First thing is we're going to look to get long in and around the 111.50 or a retest of this bottom trend line down here. If this doesn't happen, if this does not give us the opportunity, we have option 2. Option 2 is a daily close above the trend line here. I'm going to look for a pullback into these highs here, a retest of the trend line in and around 114, where we're going to go for extended targets of 121.50. Phoenix Blue traders and Protege team, they do know our stop management. They do know exactly how we will be looking at trading this. Our entries will be done through limit orders and our stops will be a maximum 40 pips on this particular one. Now let's have a look at the commitment of traders report on the dollar yen, or not dollar yen I should say, on yen, because it is a futures contract. Okay, so it's not a cross pair, you look at it on its own. So what we're going to look at is we're going to look at the long contracts. Now you're probably going to struggle to see, but just behind here, this red line, you see this red line that's moving up and down and the blue line that's moving up and down. This isn't an indicator. This is actually telling us how people or institutions are positioned in the market. Okay? Very, 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 very powerful information. Now, you'll notice that I've written on this particular chart that it says all-time high short contracts. So what this means is the commercials right now currently have more short contracts of yen than they've ever had since this report has been published. Now, if that's not a signal, if we tie it in with technical trading to be potentially selling yen, then I don't know what is. We also then notice that we have an extreme short net position. This is the blue line. So a short net position means that you subtract their long contracts from their short contracts and it gives you a net position. And that's what this yellow horizontal is down here. So we can see that the blue line comes here, and if we go all the way back to 2008, just before 2008, this was the previous lowest net position. Okay, so what this tells me is not only do we have the most amount of short contracts, but going back over 7 years in terms of net position, how they are positioned in the commercial world, they believe that we're going to see further downside. And when you cross-reference this kind of information with what happens on the chart, it's a very, very powerful style of trading. Okay, next up we've got GBP USD. Now, what we're looking at here is a little bit of a correction on this market. Okay, so we've seen a break of a current trend line, and what we are anticipating is maybe a little bit further sell-off in the dollar before we might get a strengthen. So how do we want to actually trade this? Well, we're looking for the market to come back down to about 142.10 should it do that. So we're going to look for a little bit of short-term rallying in sterling initially. So we're going to look for it to pull back. We're going to look to get long at 142.10, and our stops, I have made a clerical error here, guys, so please forgive me. Our stops are going to be at 141.70. Our target one for new traders are going to be 50 pips, and for advanced traders, well, you can choose. The reason I say you can choose is because you've been working with myself or Tom now for a period of time where you're starting to understand technicals and fundamentals in a certain manner, that you then develop your own style of trade management. And this is where we like each individual trader to develop their own style based on the information and techniques that we've been teaching. Okay, one style doesn't fit all. We like you to develop your own through back testing, through live trading, and looking at how the markets react to certain types of information. Now, we can see that when we look at 142.10, it's not just a number that we've picked out of the sky. The reason we picked this number is we've got multiple fibs coming in at one point. We've got a 23.6 and a 61.8. Plus we've also got, we're looking for a potential pullback to maybe retest this trend line. And if we look across these fib numbers, you'll see very, very nice interaction with price. We can see lots of opening and closes and tips of wicks on this particular fib level. Then we're looking at the market to potentially run up. Maximum sort of targets, I would be saying you want to be looking at in around 145.20. Extended targets, if you really did believe it was going to go on, could be up at 146s, but I think you're really testing the market to do that. Now let's have a look at what's going on with GBP, sterling, not cable, but sterling. Now the reason I say sterling is again because we're looking at the commitment of traders and we're looking at the futures contract. So here we've got three lines on this chart. We've got a green line, a red line, and a blue line. Well, you already know that the red line is the short contracts. You know that the blue line is the net position. So the green line represents long contracts. So this shows you the commercials are buying. And how do we know they're buying? Well, we know they're buying because if you look at this green line, it's increasing, it's going up. Okay, we can also see that they're increasing their short contracts as well. But what's potentially going to be driving this market? Well, the net position is increasing. So that means they're increasing their long contracts more than they're increasing their short contracts. So there's very aggressive buying. We can see we're an extreme looking at the 18-month look back. Now we do sometimes get good reactions with the 18-month extreme. As you can see here, we got an initial rally, and then here we got another rally before we got the next bull move. Here we looked to sell off, it didn't really happen. Here we looked to sell off, and my God, did it happen. Here we looked to sell off here, we got a little bit of a reaction. Again, it looked to sell off here, and we got an absolute beauty of a reaction. So you can see that this style of trading does work, and it works very, very well, but you have to be patient. You might get one signal a year or two signals a year by looking for this kind of trading, but when it is a signal is there, it's a monster of a move. If you're liking what I'm showing you here with the commitment of traders, please drop me an email at mark@phoenixblue.co.uk, and if it's something you want to learn about, please drop me an email with your questions, and I'll get back to you within sort of 48 hours on telling you how we can look at running through this kind of information. So we're looking at a correction potential move on cable. We also do have a seasonal pattern through March where we do see bullish moves on pound, so I would expect to see that go a little bit further. Here we have the dollar Swiss. Okay, now if you remember from our DXY, our dollar index chart, you'll have seen the 97.50, the 95.50. Well, guess what? That's this little trap range here between parity at 1 and the 98 level. So we could see this red directional arrow. What happens? Through neutrality, okay, we could see that happen. We could look to trade the range, but remember we've got news out this week from the Swiss, we've got news out from the Fed. The reason I give you this information ahead of time is so that you can risk manage correctly, okay? There's no point being in a market, taking loads of trades, you not knowing what news is coming out, and then the market yo-yos, whipsaws, and you lose 10 or 15%. Okay, that's not the art of trading. I hear about all these organizations that go, oh, we've made hundreds of percent this week, or 10%, 20%, and they're probably risking 2-3%, or when they have a bad week, they don't talk about it. Why? Because they've probably lost the same amount, or maybe even more. Now, the one thing at Phoenix Blue is you'll always hear about our winning trades and our losing trades. And we're never ashamed to admit that, because any organization that doesn't talk about their losing trades is probably trying to kid someone, okay? And we're not here to kid someone. This is an art, it's a technical skill, and it takes a long time to master, but with hard work it's a very, very brilliant industry to be involved in. So the other option, and the other option I believe is probably the safest option right now, especially with the news coming up. So the safest option for me is looking to trade this symmetrical triangle, so looking to buy here, sell here, buy here, and we can see that the reaction that it's had significantly from these particular touches in the past. If you are going to trade from the dollar index range that I've highlighted, the red line, then what I would suggest is you reduce your risk. Okay, so if the technicals match up and we do see reason to be going long here or short here, then what I want you to do is make sure you are trading at the correct risk exposure, because it only takes the Swiss bank to announce something and we could see this market up at 1.04. We only need the Fed to announce something and we could see this market back down at 94s. Okay, and we don't want a repeat of what happened in January 15, where the Swiss franc increased in strength by 30% and brokers around the world went bankrupt and traders lost millions and millions of pounds in a second. Okay, we don't want a repeat of that, so this is a market I'd be pretty cautious on. Okay, Kiwi dollar, we're looking at this particular market. Our bias is to the short side from what I told you about the RBNZ. Okay, the RBNZ, as we stated earlier, are short this market. Sorry, incorrect information. They have cut interest rates. Therefore, it's giving us a bias to be short this market. Now, just because they've cut interest rates, it doesn't mean I'm going to go ahead and start selling this market everywhere. I still want to see technical reasons. So if we have a look, now you'll notice that I've drawn my fib from here and not here. Now, the reason for this is if you go on to multiple brokerages, this spike here doesn't exist on most brokerages. So it is a glitch in data. Okay, so we've gone from the low up to the high, and you'll see that my 61.8 comes in beautifully around the 68.40, 68.50 level. And we can see at this area we've got a lovely supply zone. A supply zone is a ceiling. That means we expect the market to potentially sell off. So if we are fortunate enough to see the market come up and test this area again, we will be a seller at this market. If it doesn't rally and it starts to sell off prior to that, then the other option that I'm going to have as a trader here at Phoenix Blue and my protege team will be looking at a clear close below this trend line here, the thicker line. Okay, this one going through here was our previous trend line that we saw open below and then rally. I've left them both in there, but it's this second one here, the lower one of the two. I want to see a close below and then a pullback retest in and around this area here, which will probably be around 66 area, something like that, big number. Okay, And then we could look at putting our fibs in, see what correlates, and then we'll look to run this short back down to extended targets of 63.30s. Now, if we look at silver and gold, okay, you'll see that I've put 5% and 0%. What that means is that on silver, we've got a commercial extreme of 5%. This means the commercials are selling silver, and it's not quite at 0% looking back 6 months. So 0% means that they would have their most bearish net position looking back 6 months, but in terms of a scale, it's pretty much there. Gold, they do have their most bearish position looking back 6 months. Now, the downside to trading gold over silver in this particular instance is the technical reasons to go short gold aren't as good as they are silver. So the top chart here is silver. We can see we've got a lovely trend line here, multiple touches, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. It's just stunning, okay? So what we'll look for is a pullback in and around this region, around 1570, to get short and look to run it all the way down, extended at about $14, where we'd look to stop and reverse. And what I mean stop and reverse is we are seeing this year is a risk-off market, so we're expecting to see strength in the commodity prices, i.e. gold and silver. So stop and reverse means we'll be looking to get long in and around the $14 area as well. But short term, we see further downside until we get a break and close above this longer term trend line. So silver will look to get short from around 1570 if at all possible. If not, then we're looking for a daily close below 1510, and we'll look for a pullback and retest of that level, short it down to 1470 and then down to 1410. Gold, well, we've got a couple of options here. One will be very aggressive, which would be maybe looking to sell it from the top of the rising wedge. However, our preferred option here at Phoenix Blue would be a daily close below the rising wedge and then a pullback to where we actually went long last week at 1244. Now, obviously, because we're going short, we want to get our best price for entry, so we'll be looking in around 1244 to 1250 to get short. Our Protege team members will get our exact entry prices once the market has presented itself with the opportunity. And what I mean by that is once the market has closed below the rising wedge, and this has to be a daily close, not a 4-hourly, not a 1-hourly. We want to see a clear break and close below. Once we see that, then we'll look for a pullback, and we're going to wait for the retest, and then we'll look to short it in the direction that we believe it's going to go over the short term. Last but not least, crude. Okay, so crude oil, we're looking at this particular chart here. This is a weekly chart. We've seen that last week made a clear close and a bullish move above the trend line. Now, what you'll notice is I've got two sort of red zones. Those red zones are where we've got multiple fib levels that correlate with structure. We do have a seasonal period throughout May, or up to May I should say, with crude, where we're probably going to expect to see this maybe run a little bit further. Our stance on how bullish crude is or how high it might run is a little bit vague at the minute, and the reason I say that is when we look at our commitment to traders report, the commercials aren't aggressively buying it. We did have a signal 3 weeks ago from here that the commercials were extreme long. Now, although they were extreme long, and everyone in hindsight is looking at this now going, oh, there was a double bottom, we could have traded this. Hindsight is a wonderful thing, and I'd love to say we took it, but we didn't. And the reason we didn't take it is because according to the commercials report, they weren't actually buying it. And what I mean by that, their long contracts at this point wasn't increasing. So when you see a market that's collapsing like this, the commercials should be aggressively buying, or at least increasing their long positions. And the fact that at this point here, the commercials still weren't aggressively buying, didn't give us the confidence that the market was about to turn. So whether this is just a short-term correction where we might see it come up, a little pullback, a bit like this here, because this was an extreme, and we saw good 5, 6, 7 weeks of a bullish move before we then got the next leg down, which could well happen because the commercials, like I said, the long contracts are in and around the 600,000 barrier right now, and they've been there for a considerable amount of time. So there's nothing really changed on the commercial side of it. So why are we getting this run? What is causing it? So we envisage that there might be a long opportunity, and the long opportunity could come in and around $35.50 to $34 through this green fib level here. So we might see that the market pull down, retest the trend line that it's broken, come into the weekly structure, and we'll look to get first targets out by $38, $39, and then we'll look for an extended target up to about $45. And we can see that this is a multiple fib overlap again. We can see we've got the 50 and the 23.6 all sitting in at the same level. Now, if we look left, we can see lovely structure through this point. So I would expect to see a market correction, or maybe even a pause or halt in the market. So this is where we'll look to take our money off the table before we then wait for our next direction. Maybe even a potential short from this point onwards. Okay. Other than that, what have we got running? Okay, trades running at the minute. We've got cocoa. We're in from 28.73. Our stops are at break even, and we've already banked half profits. Beautiful position to be in, and we are looking at adding into this market. You've probably seen that throughout the Trading Tuesdays. You've probably seen it throughout the morning updates. Either myself or Tom Colley have talked about this market. It's something we've been in now for a few weeks, and we're hoping to see this run on to about 3,300s. We've got an add-in entry at 29.90, stops at 29.38. We'll take a first target at 30.60 with a second target of 33.10, same as our initial entry up here. Okay, other resting orders we've got are the dollar yen at 111.15 with stops at 110.75, and our target one is 12.30 with an extended target of 114. Now guys, as I've said, you've seen those orders resting on the chart. The other charts that you've seen, this is something that we're actually looking at trading. Okay, these are things that we're looking at doing live here in Phoenix Blue, and trade with caution. We've got major news coming out this week, so even if you're not going to trade this week, it's not a bad thing. Wait for the direction. Okay, we've got major news announcements, so please be careful. Enjoy the Sunday afternoon. Make sure you've got your preparation done. If you haven't got your preparation done, why not? You're not taking it seriously enough. Again, if you do like what you see and you enjoy the information that we present here and you would like to be a part of the team, drop me an email to mark@phoenixblue.co.uk. It's a great group. We love working together. It's even better to be making money. And you can follow us on the YouTube Phoenix Blue Trading channel. You can follow us on Instagram at Phoenix Blue Trading. Emails either info@phoenixblue.co.uk or mark@phoenixblue.co.uk. Facebook, we do have our page at Phoenix Blue Trading, and unfortunately the Phoenix Blue website is really taking some time to develop, so we apologize for that, but it will be coming soon. Okay guys, have a great weekend and look forward to seeing you for the morning update.